Hi, I'm Aline Braun, markets reporter with CoinDesk. This is day 2 here at Davos, and I'm joined by Brett Harrison, who's the head of FTX US. Thank you, Brett, for joining us.
Thank you.
I want to get right into it, and I want to talk a little bit about Terra and Luna. Stablecoins have sort of become the liquidity in crypto markets, and now that we're sort of seeing this shadow over stablecoins with everything that's happened with UST, and USDT also lost its peg briefly. Do you think crypto traders are going to rely less on stablecoins? And if so, what would be the alternative for the crypto industry?
Sure. So first, no, I don't think we're going to see less demand for the use of stablecoins in crypto. But let's first back up for a bit and talk about stablecoins in general, because this word stablecoin is used in a lot of different contexts to mean different things. So there are fiat-backed stablecoins where you have something like USDC, which is fully reserved. It's a crypto dollar. It's $1 in, $1 USDC out. Then you have on the complete opposite end of the spectrum something like UST, the Terra stablecoin, which is not a stablecoin at all. It's like an auto-rebalancing structured product backed by a volatile asset. And it's basically a subsidized peg. So if the peg were to get lost and the value of UST is to drop below 1, then the Treasury would go buy out more of these assets to help subsidize the price. And of course that would work until it doesn't. If there's too much of a run on that asset, if the asset gets too volatile, if the price goes down too much. And so that was never really going to last forever. It's very different than a USDC. Most of the underpinnings of DeFi, and even for centralized finance as well, come from these fiat-backed stablecoins, which I don't think are at risk at all compared to something like Terra. Also, for Tether, it's important to note that Tether never lost its peg. The peg being that you can always exchange one Tether for one USD. In fact, customers were able to redeem close to $7 billion worth of Tether over the course of 48 hours. They clearly had the reserves to be able to offer that one-for-one peg. Now, of course, while waiting for that redemption to happen, there was such a demand for liquidity for redemptions that the market price dropped below 1 temporarily, but the actual peg itself always kept.
Okay, so you were saying that UST basically was never going to be able to be what it was intended to be. So do you think crypto exchanges should sort of play a role as a gatekeeper to not let coins be traded on their exchange that are not very promising to begin with?
So on traditional equity exchanges, on futures exchanges, on commodity exchanges, and on crypto exchanges, you have assets of various degrees of volatility. What's important is the disclosure of risks that come with it. So UST was a completely open crypto. I mean, the code for what was actually going on there was completely open source. Everyone knew exactly how it worked. It was a subsidized peg. So there was no lack of transparency there. And everyone understood there was risk in the asset itself. I mean, to be able to offer a 20% yield on a token, that sort of very high yield doesn't come without its risks. So it brings up an interesting question as an exchange, whether it is our job to protect investors from having any sort of risk or volatility versus things that we screen out assets all the time that we think aren't legitimate or don't actually have a transparency or long-term value in that way. And so it's a fine line for us to sort of to decide whether we want to cross or not. But the most important thing is disclosure. And it's why we think it's so important for there to be regulation around stable coins to make sure that if someone wants to call themselves a stable coin, it actually is a stable coin and not this sort of risky asset.
Yeah. Do you think that there's going to be a regulatory framework on what should be listed or what can be listed and what cannot be listed?
So maybe two things you might be talking about. One is whether something can be listed and call itself a stable coin.
Okay.
And then one is whether it can be listed at all. So to answer the first, absolutely. I think there's, even in the United States, there's bills that have been proposed by Congress members that that actually talk about, for example, what kinds of assets a stablecoin can hold to call itself a stablecoin. It has to be either cash or very highly liquid treasuries or high-grade commercial paper. What kinds of insurance might be required in those deposits, regular audits that will be required in those deposits, what kind of license you might need to be able to offer a stablecoin. So that's sort of one side. On the listing side, there are many jurisdictions that already have standards for what you can list. For example, even in New York State, the DFS has a green list of what assets you're allowed to list. In different jurisdictions around the world, like Japan, similar deal, you have to get approval from the Japanese regulator in order to be able to list certain tokens. And so we would love to see, in general, more clarity from, for example, the market regulators in the United States on being able to understand exactly what assets can be listed by an exchange.
Okay, so let's talk about markets a little bit. I guess my first question would be, do you think there is going to be competition between traditional exchanges and crypto exchanges in the near future?
It's an interesting question. I think we've seen a number of traditional exchanges talk about getting into crypto-related projects or exchange offerings. I mean, we heard ICE and NYSE talk about getting into NFTs. NASDAQ has announced that they have a digital asset arm and they're looking into that as well. I think it's very possible that traditional exchanges might want to get into crypto in that way. I mean, we have a strategic partnership with IEX. We're working together on digital asset securities regulation and market structure. So I think it's quite possible. But I also think the other way could be true as well. We launched a stocks offering on our platform, and we're not an exchange. We're a broker that's introducing stock trading to exchanges, but we may very well in the future become a competitor to traditional exchanges as well. We certainly are on the derivatives space, where we have LedgerX, now FTX US Derivatives, which is basically a competitor to traditional derivatives exchanges like ICE and CME.
Are you afraid of that competition in the future?
We're not afraid of the competition. We welcome the competition, but there certainly is competition. I mean, we already see a lot of pushback from the incumbents in the space on our application to the CFTC to enable margin or clearinghouse. So there's definitely a lot of concern from our competitors that we're going to come in and disrupt the space, and that's exactly what we hope to do.
Okay, so I want to talk a little bit about the correlation between the crypto market and the equity market.
Sure.
Do you see that correlation break anytime in the future, and if so, what do you think could break it?
So right now we're in a global environment where assets are going down. That's true across equities, bonds, broad-based futures of various kinds, crypto, and there's a lot of macroeconomic factors going into these down moves. There's also specific things to crypto, for example, everything that happened with the Terra ecosystem. What we are finding now is, as crypto gains more mainstream adoption, that means that more institutions are allocating percentages of their portfolio to crypto, which means in a down move, when they're looking for things to sell, well, crypto is going to be in the line of fire just like everything else. And so in a sort of violent downturn, all correlations go to one. Everything is going down. And so right now, as prices are sort of decreasing across the board, of course there's going to be high correlations between these assets. As the market starts to turn around, I think we're going to see more of the idiosyncratic moves between crypto and the traditional equity markets. Okay,
and do you think, or do you see more institutional investors exiting or entering this space right now during the current market sell-off?
That's a good question. I think it's really going to be a mix. I mean, we're going to see some institutions that think, well, this could be a perfect time to re-enter the market at favorable prices. We're going to see some that feel that even though the sort of contagion of the Terra meltdown was sort of contained, they might see that as a reason to be more skeptical of crypto as a whole asset class and might kind of cool off on investment, whether that's public or private investment. So we're sort of going to see a mix for that over time. But I think that in general, so much capital has moved into the private equity space in crypto. There's a lot of teams that are building, creating new infrastructure, building out new projects, that we're probably going to see a lot of that investment come back over time.
Well, awesome, Brett. Thanks for talking to us.
Great.